Hey, I'm Jonathan Wild, and we are going to cover how to use weighted average for inventory costing under a periodic inventory system. The weighted average or average cost method involves computing weighted average cost per unit of inventory at the end of the period. That average is then used to compute cost of goods sold and ending inventory. For example, let's say a company bought 3 identical units of inventory. 1 unit on June 2nd for $10, 1 unit on the 4th for $11, and 1 unit on the 25th for $15. On June 28th, we sold one of those units for $21. To compute the weighted average cost per unit, we take cost of goods available for sale and divide that by the number of units available for sale. In our example, we add the inventory costs of $10, $11, and $15 per unit to get cost of goods available for sale of $36. We divide that by 3 units to get an average cost of $12 per unit. Because we sold 1 unit, we report $12 as cost of goods sold on the income statement. And because we have 2 units left in inventory, we multiply that by the $12 weighted average cost to get $24 reported on the balance sheet. The weighted average method can only be used when our inventory consists of identical units. For example, if we are selling identical gallons of milk, we could use the weighted average method. However, if we are selling one-of-a-kind custom cars, we would not use the weighted average method. Okay, let's do an example. Assume our records show that on May 1st, we had 20 units in inventory that had cost $30 each. On May 3rd, we purchased 30 units of inventory for $35 each. On May 11th, we purchased 5 units for $45 each. And on May 28th, we purchased 10 units for $48 each. We take that information and fill it into the goods available for sale column. Next, we need to determine our weighted average cost per unit. Therefore, we add up our units available for sale and cost of those units, which gets us 65 units with a cost of $2,355. To compute weighted average cost per unit, we take the cost of goods available for sale, or $2,355, and divide that by 65 units available for sale. This gets us $36.23 weighted average cost per unit when we round to 2 decimal places. Next, we want to compute cost of goods sold. Looking at our sales data, we see that 60 units have been sold. Using weighted average, we multiply 60 units by $36.23 average cost per unit to get $2,173.80, which can be rounded to $2,174. This amount is the cost of goods sold during this month and will be reported on the income statement. Last, we need to determine ending inventory. This is computed as goods available for sale minus cost of goods sold. Looking at our table, we see 65 units of goods available for sale, and that 60 of those units are now in cost of goods sold. That leaves us with 5 units remaining in ending inventory. Using weighted average, we multiply 5 units by $36.23 average cost per unit to get $181.15, which can be rounded to $181. This amount is reported as inventory on the balance sheet.